Okay. Good evening, everyone. I'm Dr. Mike Cromer, president of the Hillsborough County Medical Association. Thanks for joining us again tonight on part 2 of this spring session's retirement planning for physicians seminar. Happy to have with us Mike Jensen and Jeff Anderson of Jensen Anderson Wealth Management Company. And I'm going to turn it over to them in just a minute. Some of you were with us last week and are familiar with the Zoom type of a format. But at any time, if you want to ask a question about the topic being discussed, please press your icon onto the chat icon, press your arrow on the chat icon and ask your question. I'll be monitoring that through the evening and bring the question to the attention of the panelists. So we want to say thanks again to Mike and Jeff for offering this to all of our members. It's an important topic at this time in our life. And Mike, I'll turn it over to you at this time.
Okay, thank you, Doctor. Most will probably be on from last week, but I just want to begin today's session with these points. Once again, remember, when Jeff and I are teaching classes, we do it in a conversational manner. Not only do Jeff and I ask questions back and forth, but we expect those in our classes to do that because that's how you learn. So please do that. Jeff, do you want to say something before I start to talk about the Social Security intro?
Sure. Just a couple housekeeping items. You guys everyone has books, session 1 and session 2. We're using a different presentation that's not in the book for Social Security. However, in the book in session 1, there is a Social Security chapter that's very good as well. So we like to give you 2 different perspectives when it comes to Social Security. After the Social Security presentation, we will be starting on the investments in session 2. If anybody leaves early, just so you know how these wrap up, you will get an evaluation sent to you by ALCA. We appreciate your feedback. We're always constantly changing the curriculum that we present. Inside that, on that evaluation, you'll also get the opportunity to get a full plan done. It's part of our agreement with the HCMA. So if you would like to take advantage of that, it's usually a $1,500 charge. It's waived because you're an attendee of this course. So if you'd like to take advantage of that, you can just reply to ALCA and she'll put you in contact with us. And that holds true with Bill McQueen with last week. If you have any questions for him or the CPA, Jason Hamlin, you can reach out to us and we can get something scheduled for you if you have questions or need to get something taken care of. And Michael, that's all I got.
Okay, we're going to begin tonight with Social Security. Now, one of the things that I ask you to do this evening is pay attention, especially in the beginning, but even at the end. But in Social Security, there are so many myths about that, or whatever they're saying on CNN that evening or something. But we're going to give you what the facts are on Social Security. All right. So look at that gentleman there. He looks a little confused and trying to understand something. And I can understand that when you're talking about Social Security, okay? And they begin this with would you rather be early or delayed and pay a penalty? Now that phrase is going to mean a lot as we go through how Social Security works. Jeff?
Yep. So the big question is, let's see here. Will Social Security be there for me? So Mike, want to go over these numbers?
Yes. Let's break some myths right now. Social Security is going to be there. Okay. It will be there. And then even if you look at ahead of plans, it says that, oh, it's going to expire in 39 or something like that. But all that the government has to do, all that the Treasury has to do is make a couple of fine-tooth changes. You can move back to that other one, Jeff. Excuse me for getting off track there. The thing I wanted to point out is that if you just look at the money that's used to fund Social Security, At the end of 2019, there was $2.89 trillion there. Okay. Now here we are at the end of 20, there's 2.908 trillion. So there's actually more. They can regulate how much money they went in there. Okay. So it will be there. They can always increase the age before you start it. That'll do things. That'll extend it. They could either, instead of the current $142,800 of your earnings that is subject to Social Security, all they have to do is move that up a little bit and it extends. So in short, look at these facts and realize that Social Security is financially viable and it's not going anywhere. Go ahead,
I think the biggest target would be to increase the maximum earnings. Currently only subjected to 142,000 to pay Social Security. That would probably be the first step of where they would target.
And it doesn't affect many people in the country.
No.
Only us.
Yeah. So inflation, Social Security is inflation protected. They base it on the CPI, and they give you an increase every year in most cases. And that's a big part of it. I'm going to go over this chart here that if your monthly benefit is $2,000 today, and you live 10 years, you'd have taken out $276,000 out of the system. If you live for 20 years, you've taken out $600,000. And if you live 30 years, you've taken over $1 million out of the Social Security system. So it's a pretty big chunk of change. I know the monthly benefit, $2,000 may not seem a lot to a lot of high income earners, but it's $1 million that you can end up getting back of taxes that you paid, which is pretty nice.
Yeah. Hey, Jeff, could you turn back 3 slides a minute? Not there. Next one. Right there on that one, that middle, the second dot, there's a group of people born between 54 and 1960. What is the normal retirement age for those?
There's a chart. We're going to go over.
Okay.
Yep. A couple more slides. We're almost there.
Okay.
That will be answered.
But don't discount the cost of living adjustment in Social Security. It's actually pretty high compared to other COLAs. But a lot of people don't talk about that, but it's a very good COLA. Go ahead, Jeff.
Historically, it's around 2%. So if your monthly benefit was $2,000 today, 10 years from now, it'd be $2,400. 20 years from now, it'd be almost $3,000. And in 30 years, it's $3,600 a month. So a substantial increase with the COLA.
And the cost of living adjustment is determined on how the economy is doing. If the inflation rate goes up, so is the COLA going to go up. You know, we've had low inflation the last few years, and so that's why it's at 2%. Good.
Very good point. So how much can I expect? How do they calculate my Social Security? It's based on your earnings. There's a formula, which I'll show you here in a minute, but it's based on your 35 highest years of earnings. And there's an average, an inflation adjusted average that they take. So a lot of people think that it might only be your highest 5 or 10 years, but it's actually a 35-year average. So it's a long history. So that means, like, if you retire a little bit earlier, a few years earlier than you anticipated, it might not be that as impacted as you think. But when you read those statements are acting as if you are working to those ages that they show you. So that does play a role. If you go out a little bit earlier, in theory, you're taking out a few of those higher earning years. If anyone's having trouble sleeping at night, they can take a look at this and try to calculate. Yeah, that's the benefit formula. But it's based on 35 years of earning history.
Now.
Yeah. So, Mike, you want to talk about taking it early or waiting?
Let me talk in general about this. Okay. Wait till age 70. And we're going to explain this point by point. Okay. The time that you might take it early, the people on this call are not going to have to worry about income on that. Okay. But there are some things that could cause you to take it early. That would be your health or your life expectancy. If you know you're terminal, then take it. But otherwise, most probably you should wait until you're age 70. before you take it, because they increase it by 8% every year between your normal retirement age and age 70. It's a bonus. And then after that, all the years that you're on Social Security, they're basing the COLA on where you started. So by waiting to age 70, and you'll see the numbers in a little bit, it just increases the amount of money you're going to receive. Yeah, Jeff.
This chart is actually addresses the question that Dr. Cromer brought up, which is what year I'm born and what my FRA is, which is my full retirement age. That's the age that I can take Social Security without any reduction in benefit. All right. And that's the chart there.
So you
Okay,
see 54 and 55, doctor?
Yeah. So anything over 54.
Yeah, that breaks it down really clear.
Yeah. Okay. All right.
So you're just from terminology, the PIA represents what's called your primary insurance amount. That is the full amount that you would get at your FRA, which is your full retirement amount, full retirement age. Okay, so if your full retirement age is 66 and you take it at 62, you're looking at a 25% reduction off of your PIA, or a 25% reduction in your benefit. If your retirement age is 67 and you go out at 62, it's a 30% reduction in your, and then it's a graduated scale up. So every year it gets a little bit more. All right. So if you go out early, then there's a reduction. If you wait, this is what Mike was talking about earlier. If you wait about anything above your full retirement age up to age 70, you get an 8% increase on an annual basis every year you wait.
And look at the difference between age 66 and 70. It goes from 93 to 124%. And that's just as your base.
Yeah.
Okay. Before we start adding the COLA on every year.
Yeah. And even if you go a step above that, even if you look at 67, if you took it early, 30% reduction and 124%. So it's a 54% difference in payment if you take it early or you wait. So obviously if you've got the means, the best, when your health is good, then 78% return on your money guaranteed is a pretty good rate, right?
Yeah.
Yeah.
Okay.
All right. So you get your annual statements, and you can log in and get those statements to the socialsecurity.gov. You want to check your numbers for sure. They mess up all the time.
I was just going to say that. That's right. They mess up a lot of times with your numbers. So please remember to go in and check and see if they're. Jeff just brought up a great point, because a lot of people don't think they mess that up. Oh, it's Social Security, but they do a lot. So make sure that you go in and check. Thanks, Jeff.
Absolutely. And remember, when you get those statements, once again, it acts as if you look at your 67 full retirement age and you look at that number, it's acting as if you're working to age 67. If you're looking at 70, we're looking as if you're working to age 70. So based on your historical numbers. So that's just something to consider, that it will be a little bit less if you go out early or you stop working and take it later. So, all right. So this just talks about why delay. Once again, the numbers are a lot bigger. You know, your benefit at age 70, if you claimed at 62, and this is assuming a $3,000 primary insurance amount at a full retirement age of 67, at age 70, you would have been at $2,400. If you claimed at 67, you'd be at $3,500. And if you claimed at 70, you'd be at $4,300, and you'd be getting the 2% COLA on that number. So considerable difference. When you look at age 100, you're at 7,800 versus 4,400. So big numbers. So how can I maximize my benefits? Well, we talked about making sure your earnings are right. That's one quick way to, if you find a mistake, that's a quick short shot of getting it.
They miss years. Look at that point right there. That's what they do.
Yeah, that's an easy way to do it. But you want to make sure you take it out at the right time, and you design a strategy based on your financial plan. We're going to go over a couple strategies here tonight. This is one that people get a little frustrated with, which is the taxation of my Social Security. you funded Social Security by paying tax on it, but then they tax you on your Social Security on the way out, which rubs people the wrong way. If you take it early and you're still working, that doesn't make any sense if you're making more than about $19,000 a year.
Correct.
So if I took my Social Security at 62, but I'm still making $100,000 a year, $200,000 a year, $300,000 a year, it makes no sense to do it because there's a give back and it hurts you. Once you hit your full retirement age, you can work as much as you want and take Social Security. So a big decision is if we're going to take it early for whatever reason and you are still working, it doesn't make sense, assuming you're making more than $19,000. Okay.
Yes, you're basically, and you'll see this, you're basically about 85% of the money that you receive in Social Security is going to be taxed. Okay,
Yeah,
this group is in that income level. That's what 85% of what you receive will be taxable.
I mean, they're real tight on this. It's your adjusted gross income joint. If you're married filing jointly, add back in half the Social Security payments, even add back in municipal bond interest. And I'm
Even
assuming pretty much everyone in this call is going to be over $44,000 of income. Okay. So let's say your Social Security payment is $30,000. You would take 85% of that, and that's what you would be taxed at your ordinary, whatever your marginal tax bracket is. You're not paying 85% tax. It's 85% of your number gets added into your income, and then it's taxed at whatever your marginal rate is.
Ordinary income tax.
Ordinary income tax. So people get a little confused there on that. When to apply, let's get into a couple scenarios here. So spousal benefits. You're entitled to yours or half of your spouse's Social Security. For example, John's primary insurance amount is $2,000. Jane's is $800. If Jane applies at her full retirement age, her benefit would be $1,000, which is half of John's because that's higher than $800. All right, so you're always entitled to half of the higher earners through what's called the spousal benefit. There's two mutually exclusive numbers going on here. There's the spousal benefit and your own benefit. The math behind it is you have to analyze both, and there's some strategies here to try to maximize it, which we'll talk about now. You used to be able to do some real cool stuff, but they shut a lot of the cool tricks down a while ago.
A lot of the loopholes.
Yeah. So in order to take the spousal benefit, the primary worker, which is the higher, they have to file for theirs, so they have to take Social Security. The spouse must be at least age 62. And they also have to have been together for 9 months.
They have to be married for 9 months.
They have to be married for 9 months, yeah.
And the other thing to remember that Jeff said is that the primary one has to turn the money on first. And that a lot of times that doesn't happen.
Yeah.
Okay, because they're waiting until age 70. Okay, sorry.
Yeah, no. So, and this is like a hybrid strategy. We see this one used a lot. The lower earning spouse primary insurance amount is less than 50% or half of the spousal benefit. So the lower earning spouse will claim on theirs early to get some money coming into the household. The higher earning spouse will maximize their benefit up until age 70. When they turn their income on at age 70, that will trigger the half rule. And that half rule, the spousal benefit will be half of the higher earner's primary insurance amount at their full retirement age. So a couple things there. On the spousal, you don't get an 8% increase every year you wait, right? So in this scenario, what they're doing is
they're taking the money.
Yeah, they're taking their own because they can't take the spousal because the higher earning spouse hasn't filed yet. When the higher earning spouse files at 70, that'll automatically trigger a raise, and the Social Security Administration will instantly rise you up to meet the half if it's higher. All right. So that's a common one that's used because, you start getting some money into the household, and then you maximize one of them. And we're going to talk about what happens at death here in a minute.
One of the things that you're going to see in a moment is the way that in a divorce, how the spouses are taking care of both of them, even though they're divorced. There's benefits. Okay, go ahead.
So in the situation where in a widow situation or somebody dies, you get the higher of the two if you're already claiming. If you're not claiming yet, you can start taking the benefit at age 60, but it's reduced by more. So they do allow you to take it earlier than the age 62 in a death situation if you're not already on Social Security yet. But if you wait till the full retirement age, you'll get the higher earners full retirement amount at your full retirement age without a reduction. Now that was if they died before they were taking Social Security. If a person dies while you're both taking Social Security, in this example, Joe and Julie are married. They're both over their full retirement age. Julie benefit is $2,000. Joe's benefits at $1,200. Julie dies. Joe notifies Social Security, and Joe will get the higher of the two. It would be $2,000. So this also supports waiting to 70, at least one person, because the survivor gets the higher of the two. So if you can get one really high, that helps from a risk management perspective in regards to death. You get the higher of the two. Okay, so that helps.
So you've heard a few times, wait till 70.
Yep. This example, Joe and Julie are married. Julie's primary insurance amount is $2,000. Julie files for Social Security at age 70. Her benefit is 128% of the $2,000, right? Because it's gone up by 8% a year. So she gets to $2,560. If Julie dies, this is what the example I just talked about, Joe's survivor benefit will be equal to $2,560. If Joe claimed early, and let's say Joe wasn't on Social Security yet, there's an age difference, Joe would get it reduced if he went out at 60. If Joe claims a survivor benefit at his full retirement age, he would get the $2,560, the full amount for Julie. All right. So in this case, Julie was a lot older than Joe because Joe had the option to take it at 60, which means there was at least a 10-year age difference in this example. So the rules for the survivor benefit, this was where the couples have to be married at least 9 months, except in case of an accident.
Right.
The survivor must be at least 60 to start taking it. For divorces, this is a very interesting one. If you were divorced and you were not remarried, you are entitled to half of the former spouse's Social Security with no impact on he or she. You just have to have been married at least 10 years and not remarried. And the ex-spouse has to be at least age 62. And the divorce had to have been more than 2 years ago.
It does not affect it. If you're divorced, okay, it does not affect what you're going to receive anyway. They're all funded to fund for divorce.
Yeah. And let's say I was divorced 5 times and I was married for 10 years 5 times. Absurd example, but I could have 5 different people taking off half of my Social Security because I was married for 10 years to 5 different people. Okay. That's just the example of how it works. And that doesn't impact, in this example, myself. If I was married 5 times, I don't even know what's happening. It's going on behind the scenes. You don't know that somebody else is filing, and it doesn't impact you. So any ex-spouses, as long as they're not remarried and they're married for 10 years, they can file for that.
One less problem.
Well, we've had several people ask if they can take multiple ex-spouses and add them all together. You can't do that. You would take the highest of any ex-spouse, assuming that you were married for over 10 years. This goes back, we're going to probably end this, but this goes back to delaying. Whose best interest do you think? They call it a penalty for taking it early, and you get a bonus for taking it later. It probably makes a lot of sense to take the bonus if you can.
Yes, in fact, it's almost always best to wait and take the bonus. There's that 8% increase every year up to age 70, as you saw earlier, is tremendous. So don't listen to other people. Wait till you're 70.
All right.
Bill covered estate planning, so we're going to, the attorney last week covered estate planning, so we're going to skip that part because we did it last week.
All right. Give me 1 second.
Okay.
Oh, I guess gotta go back. I don't know why it's freezing up on me. We are going to be starting. We're now starting officially session 2, and we will be starting at the beginning of the book, which is the investments chapter. Just a little bit of a reminder: we do not cover every page. So if you are going to take notes on the pages, we do skip some pages. So the page is in the top right-hand corner of the slide. So if you want to stay along that way.
Okay, so what you're going to see in this part of the class is that we're literally going to be standing here as though we're teaching basic finance 101, maybe finance 301. So these are just basic considerations and things that you should learn to do if you're not doing them already. Okay. You want me to start off here, Jeff?
Sure.
Okay. When you make investment decisions, what is it we always say? Before you leave and go into practice, you have over 10,000 hours of training and nothing in finance. Well, one of the things that you can do is realize when you're starting to invest that you need to explore certain things and say things to yourself. Why am I investing? Are you investing for growth of your investment principal, or are you investing for income? Two major differences, okay? Especially with this group, since this is the older half of the ones that we teach. There's a different way to invest if you're looking for income. So make sure that you know that, okay? And sometimes people want it for growth and income. Go ahead, Jeff.
Time horizon.
Okay. Time horizon, all that we mean with time horizon is that the longer that you have before you retire, the more opportunity where you may take higher risk because you have a lot of time to require. But as you get older, you have a shorter time horizon, and it creates a need for more stability in your portfolio. Okay. Don't count on the market to always be doing well, especially what the heck is going on now. This is insane the past 12 months. Okay. Your time horizon is going to depend on what stage of your career, most importantly, what ages you are. Go ahead.
Another thing to look at is, where are my current investments now? You know, as you're approaching retirement and you're shifting gears possibly from the accumulation phase and going into the income phase of your life, which is a big transition, you need to analyze your current investments to see what that overall asset allocation is, and is it matching what my objectives are that I set out for this investment? Because objectives do change over time. As your time horizon gets shorter, you become more conservative. So you want to make sure you stay up to date on your current investments. And then tax efficiency is a big one. Making sure that your non-qualified assets are tax efficient, being that there's not a lot of buying and selling going on, creating taxation, so that you tax loss harvest and make sure that you try to be as tax neutral as possible in your portfolio, so you don't get hit with a lot of taxes. All right. So taxes play a big role in all of this stuff.
And when Jeff says non-qualified money, he's talking about money that's not in your retirement plans, because your retirement plans are all grown tax deferred. But non-qualified money means money that you pay with after-tax dollars, and that is open to taxation like crazy. And that's why we had the CPA here last week to help with that. Go ahead, Jeff.
Well, there's really two ways to invest money, which is, Mike, you want to give the old ownership talk?
Okay. I was taught this by a doctor, so everybody, this is important. a physician wanted to invest in a heart procedure. And he said, well, how am I going to raise money? And I said, well, it's just like stocks and bonds. There's two ways to invest, whether it's in your heart instrument or just for anything else. You can either do it by either loaning money to someone, a business or whatever, or you can do it by owning. Okay, you can invest by loaning to a bank or a government. Common examples, such as certificates of deposit, checking accounts, savings accounts, things like that. That means that you are loaning money to someone else that's going to pay you your money back and a rate of interest with it. Owning investments means that you own shares in the company. If you buy stock, you're owning a stake in the company, which is good because you have room for growth. You have the potential for an increase in the value, but there are no guarantees that you're going to get your principal back. That's basic 101. Stocks, ownership, more risk, possible higher return. Bonds, fixed income, you're loaning money, lower risk, lower rates of return. Good.
Perfect. So let's look at some loanership strategies. You give the bank your money, you open a savings account, you give them your money, they pay you interest. That's a form of ownership. CDs, same deal. You give them your money, they pay you interest, they give your money back in a certain time frame. Money markets, same thing. So those are like the lowest levels of risk. And then you get into bonds. You've got corporate bonds, government bonds, and municipal bonds. Those are the three different types. You give the entity your money, they pay you a set interest for a period of time called the duration. And at the end of that period of time, they give you your original investment back. That's loanership, right? The longer that duration, the longer the term, the higher risk. Lower risk is the shorter duration. All right. So when you look at bond risk, you look at how long until the bond matures. That's phase one. And then you look at what are the credit ratings of the bonds. And anything below BBB, under Standard & Poor's, is not investment grade. And anything under BAA is not investment grade. Under Moody's. Those are the two rating agencies.
Right. They're very important points that Jeff's making, because a lot of people with fixed income or bonds, they figure, well, there's no risk there, if I've got them in bonds. But you'll see when Jeff was discussing the different types and different ratings on the bonds, if you get something that's very long term, that's a higher risk because you're locked in. If you get something below investment grade, that's risk, and that could be as risky as a regular stock portfolio. So
Absolutely.
You have to be careful with the way you select your bonds again.
And to add to that, right now, things are getting a little tricky in the fixed income market, because when rates go up, bond prices go down. When rates go down, bond prices go up. So if you've had a bond portfolio, you've probably seen some volatility over the last couple of weeks. The yields have been spiking. The Fed came out and said they're not raising rates for a couple of years, but that's still, the bond market's starting to get volatile because we've been in a decline in bond rates for so long that has been favorable for bonds. So if you looked at your bond portfolio, it's been doing pretty well. Well, when rates start to go the other direction, the price of your bond will go down, right? Now, if I hold the bond to maturity, which we talked about, let's say I have a 10-year bond and I hold it that 10 years, I take away that risk of interest rate fluctuation causing deterioration in the value of my bond, right? What happens if I want to sell my bond? Well, I can sell it just like a stock. There's an exchange for it. So if I'm 5 years into my bond and I want to sell it, the price I'm going to get depends on where rates have gone. If rates have gone down, I'm going to get a higher price. If rates have gone up, I'm going to get a lower price. All right. Remember, you hold it to maturity, you get all your money back. If you want to sell it before that maturity ends, there's a secondary market, and the price you get is dependent upon where interest rates are going.
And that's where the risk is. Inverse relationship. Interest rates go up, bonds go down. And that's what's probably going to happen shortly.
So we covered the bond categories. You've got corporates, You've got munis, which are real popular. Mike talked about non-qualified money. In the non-qualified space, a lot of physicians who are high income earners will use municipal bonds in their non-qualified or taxable accounts. The reason for
Great
that,
tax planning to use it. Your CPAs will be telling you the same thing we're telling you.
the reason for that is it's federally tax exempt. So all the interest that you get, you don't have to pay tax on. And I don't think anyone on this call likes paying more tax than they have to. So
Jeff, is there a
munis,
catch with those munis sometimes that where the federal government comes back at you?
what's that? No, they're federally tax exempt.
Isn't there with the munis? Not all the munis can be taxed eventually.
Only from the state level.
Right. That's what. Right.
Yes, you want to make sure that in Florida we don't have state income tax, so you're fine. In some states, they tax you on the state level, but if you use their state bonds, then you're okay.
Yeah, and that's a lot of people don't realize that. They think that bonds are safe from all taxes, but federal, yes, state-wise, they will tax you unless it's one of their own bonds.
Yep, it's federally tax exempt,
Mm-hmm.
not on all the time state. Treasuries, government bonds, pretty simple, very conservative. Also probably at the lower rates. And then you will have high yields. That's also, that's usually below investment grade junk bonds. The volatility functions a lot like the markets. So if you think you want to be conservative and you're buying bonds, you want to stay away from high yield. That can get a little bit dangerous.
Yeah. And now we have the other way to invest, owning investments, building equity in a company. Okay. Their characteristics, the price. It's definitely dependent upon supply and demand. That's why you can make a lot of money in investments and you can lose a lot of money in investments if it's not done properly. Capital appreciation, that is the main reason that you'll pick an equity as opposed to a fixed income. Some of the companies are designed as you buy stock in these companies. Some of them are designed, they take all their profits and they spit it back into their company to grow, more growth oriented. But some of them will pay out higher dividends. So it's a great source of dividends as a source of income for you, especially when you're retired. Okay. Inflation rates, and they offer that protection. Good, Jeff.
Yeah, you would hope that your equities outpace inflation. That's kind of the
We
idea.
hope so. I should have said that. You're right.
It's kind of the idea of the whole thing. So back in the day, when the stock market was developed, people wanted to own shares in companies, right? So they created stocks and they could buy a percentage of ownership through the form of ownership. And you had the ability to sell it on the secondary market through the indexes, which we'll talk about here in a minute. So they had liquidity, they got voting rights. Okay. But then they wanted to be able to diversify and own multiple companies. And we'll talk about the evolution of the mutual fund here in a minute. But the secondary market, so they bring the company public. It's now traded on one of the exchanges, and you can buy and sell that stock throughout the day when the market's open, right? That's a secondary market. What determines the stock price? Well, Mike talked about it earlier, the supply and demand. If there's more sell orders than buy orders, the price is going to go down. If there's more buy orders than sell orders, it's going to go up. So when you look at the indexes, you'll see a popular one is the Dow Jones, but that's only 30 stocks. So they take, those are the 30 biggest stocks. They take the amount of shares outstanding by the share price, and that calculation is what's called market capitalization. That's what the company's really worth. So the biggest 30 is the Dow. The 500, you're looking at the most commonly used benchmarks is the S&P 500. So if I'm going to compare my stock portfolio to make sure I'm outpacing the indexes, the most commonly used is the S&P 500. It's 500 stocks.
Right. So the companies are so strong.
Absolutely. You get the NASDAQ, very tech heavy. You get the Barclays Ag, which is a bond index. Russell's, the Wilshire. So a bunch of all different indexes to track the performance in certain sectors of the market.
And remember, they all trace different aspects of the market and different types of investments. Look towards the S&P 500 as the strongest large cap U.S. domestic.
So when I look at buying a stock, there's really two different types of disciplines that you look at. There's growth, technology companies, biotech companies. They're growing fast. They're reinvesting all their money to stay ahead of everything. They got a lot of competition in those markets. They got to stay on their game. So that's a growth stock. Okay, it's going to be a little bit more aggressive. An income stock or a value stock, those are consumer cyclicals, utilities, companies that pay dividends, that have very reliable income streams, that hold a lot of cash, and that pay dividends. And for retirees or pre-retirees, we love dividends because dividends are a very reliable income stream. This allows you to receive a set dividend. It's not related to the stock price. The dividend stays the same, which is important to understand. A lot of people think, well, if the stock price went down, I'm going to get paid less. That's not the case.
Not at all.
The case is that they have to come out and say, we're going to reduce dividends this year. And that's a lot of companies.
Rarely happens.
Yeah, very, very, very rarely happens. You want companies that have paid dividends and have been raising their dividend or keeping the dividend the same for a long period of time, and it creates passive income. And we love passive income. So that's what a growth versus income or value stock. That's the first cut on when I'm analyzing a stock, which falls into one of those two categories. The next is what's called the market cap, which we talked about. 10 billion and up is large cap, 2 to 10 billion is mid cap, and below 2 billion is small cap. All right. So that's really when you look at stocks, they all fall into those categories. So if you look in the hierarchy of risk, a large cap value stock is going to be the most conservative, and a small cap growth stock would be the most aggressive. Okay, so it's small companies in always changing environment, got to stay ahead of the game. That's going to be the most aggressive. And the big companies that pay big dividends, that's pretty reliable in the overall risk.
Yeah, the larger companies aren't as concerned about growth, immediate growth with them. They're long, steady growth because they've been around. So their dividends, they're going to use their profits to pay out to their shareholders as opposed to put them back into the company as much. If you remember, we began tonight's session saying, as you get older, you're going to be looking more towards income. And that's where the higher quality stocks come in on the growth and income. They answer that very often for people.
Another term that we like to talk about just because it's often misunderstood is a stock split. A stock split gives you no really perceived value. The only reason they split a stock is just psychologically. If I'd rather pay $50 for a share of a stock than 100, but it's the same value, so it's the same market cap. It doesn't change the value of the stock. It just is a mind trick really to get people to buy at a lower price, but you're getting, there's no real value there. So it's important to understand that.
He's right. That's why they do it. They split the stock just to encourage more people to invest in the company. That's what's not how the company's doing. It's how they just want to sell more shares.
Mm-hmm. Mike, you want to talk about the do-it-yourself?
The do-it-yourself, a couple rules. First of all, there's nothing wrong with, if you have a play account with investments, to play with it and invest yourself there, that can be fun. But with your serious money, you need to use professionals to do it. You want the best minds in the world to be the ones choosing what you're going to do, because the knowledge and experience of those people is so far above what you can get normally. You can't let your emotions carry you away, which can happen to us personally if we do that. We see the stock, oh my gosh, you can't be emotional. Discipline is required, okay? And the professional managers are the ones who know better than anyone in the world. The other thing that's needed is you use people like that to help them fulfill the financial plan that you did earlier. Don't try to do it yourself. Play account, fine. Serious money, don't. It's too costly.
So what are my choices for professionally managed funds? I've got
Oh, you
mutual
mean
funds.
asset allocation?
Yep, we're going to talk about that in a minute. These are just the options. You got mutual funds, exchange traded funds, UITs, individually managed accounts, variable annuities, which we're going to talk all about those right now. Mutual funds, Mike.
Yeah. First of all, there's over 9,300 mutual funds in the United States alone. Okay. It's impossible to, for an amateur or non-professional to really pick that out. Okay. Selecting the fund is very, very important. There's a Nobel Prize awarded to 2 doctors. Thank God they were PhDs from Northwestern and not MDs. But, and their whole theory, their whole hypothesis is that when you have an overall investment portfolio, the entire portfolio, over 90%, it's actually 91.3% of the return in someone's overall portfolio does not come from when you bought the stock or bond. It does not come from when you sold the stock or bond. It doesn't even come from what the market's doing. Over 91% of the return in an overall portfolio comes from asset allocation. You know, people like us, sometimes they might talk like, did we actually know what's going to happen with the market? We don't. The only thing we know is that one year, this asset category might be way up there, and it's probably down here the next. So asset allocation is the most important part of your investment portfolio. And mutual funds, when you put $1 in a mutual fund, you have 3 cents in this stock, 8 cents in that, 4 in Amazon. It's instant diversification. So that's a huge advantage of it. Number one, asset allocation, most important thing about an overall investment portfolio. Mutual funds provide that for you right away. Okay?
Absolutely. So you've got, when you look at mutual funds, right off the bat, you've got fund families, Vanguard, Fidelity, American funds. Some of them are no load, some of them are loaded. The no load world has kind of ended. When that meant you had to pay a commission. Commissions are gone in the industry predominantly. Yeah. But then you have what's called active versus passive management. Active management is where it has a portfolio manager. And the goal of that portfolio manager is outpace the indexes, and more importantly, bring down the level of risk in down markets. In up markets, everybody's happy, but in down markets, avoiding big declines is a really, really important part of the overall process. Passive management is just indexes. If you buy the S&P 500 index, you own the index. If you buy the Russell index or you buy the Dow, those are all passive. There's no manager on there. So you're going to do exactly what the index does, right? Lower cost, by the way, because they're not paying a portfolio manager. Okay, so those are the 2 different types. Now, when you buy and sell a mutual fund, when you buy a mutual fund, you want to look at the prospectus. Inside the prospectus, we'll have all the information you could possibly need about that fund, right? Even if it's active or passive. The one big difference with a mutual fund is that it calculates the price at the end of the day. So unlike a stock, or if I put a sell order in, I get execution very quickly. I don't know what a price I'm going to get on a mutual fund. If the market's down for the day, they calculate all the stocks in that portfolio and they come up with a weighted average price, and that price is what you get, and that's called the net asset value. So if you're buying and selling your 401k and you got funds in there, you sell, you don't know what you're going to get till the end of the day. That's a big difference there. So what type of funds are there? Well, we've got small, mid cap, and large cap. We now understand what the difference between those are, right? 10 billion large cap, those are the big companies. 2 to 10 billion mid cap, 1 to 2 billion small cap. Large cap's more conservative than small cap. You've got growth, where we're just focused on making money and growing, but we're not going to get dividends in that category. Value, we are going to get dividends. That's the whole point. We want passive income off those investments. We want a nice yield off those investments where we're getting a reliable income stream. And that's value. And then index, we talked about that. That's passive management. Low fee, full participation in the index. You do whatever the index does.
And if you notice, we're classifying these mutual funds the same way that we classify any common stock portfolio. What are the purposes of those companies or those managers? Same thing carries over here into the mutual funds.
Mike, you want to cover the hybrids?
The hybrids, okay. Seeking long-term capital appreciation, that's going to be common and preferred stock, okay. When you have different types of investments in, it lowers your risk. There's different kinds of stocks, as we just said, asset allocation and mutual fund categories. Jeff, you pretty much went over the mutual fund categories.
No, well, this is hybrid. So this is a growth and income fund. So what they'll do is they'll mix two different types in one. So in this case, a growth and income fund, which you may see in your lineup of 401k choices. What's a growth and income fund? They'll have some growth stocks in there, but they'll also have some income funds in there as well, income stocks. So they get a little mix of both. You might just get a straight fixed income fund with some different types of bonds in there. A balanced fund, which you might have maybe 60% in stocks and 40% in bonds, but they kind of just invest in and balance it out for you. Mike, you have a certain name for them.
We call the balance funds cheater funds. Everybody likes them because they all think it's a stock portfolio. When the market goes up, it goes up, but it doesn't go up as much as a pure stock portfolio. When the market goes down, a balance fund goes down, but not as much. Because what people don't realize, as Jeff just pointed out, when you're in a balance fund, 30% of your assets aren't even in stocks. 30% of your assets are in fixed income and cash. So it is a great way if someone goes, well, what's your risk tolerance? Well, moderate, middle. I'm middle. That's what a balance fund is. They're very good to have. And as I said, cheater funds, they're easy to do. Growth and income, if I can make another comment on that, follow up on Jeff. Growth and income type funds, they're ones that as soon as you hear income, that means that stock has been around for a while. That fund's been around for a while, okay? And they're looking for growth. When you're choosing in your retirement portfolios, you're going to see that you have a large portion of the money that you have in growth and income funds, because they are growth funds, but because of the income, they're going to be less volatile than a regular stock. So growth and income, that's a very important hybrid fund, just as the balance fund is. Good.
And then you've got your vanilla bond funds. You've got your corporate, you've got government, you've got municipals. But remember, when you're buying the bond funds, remember what we talked about previously about the duration. You might have a long-term corporate bond fund that's going to be more risky than a short-term bond fund. And you got to look at the credit quality as well, which we talked about, the rating agencies. That plays a role when you're looking at your bond fund selection. Then you've got high yields. We talked about that before. That's going to be your junk bonds below BBB or under, high volatility. So if you're looking, this is what happens. People say, oh, I'm going to move into bonds. What's done the best historically? And you might look and say, oh, high yield's done well. Let me choose that. Well, then all of a sudden you get beat up pretty quick. And you say, whoa, I thought this was a bond. I thought I bought this for stability. And you don't get that there. They have a very high correlation to the volatility of the stock market. So stay away.
Might as well stay in stocks if you're going to be playing around with junk bonds. That's for sure.
Absolutely. And then you got money markets. You know, you always have, like, if you have a brokerage account, you'll have a money market inside of it. So when you sell stuff off, it'll go there. It's just a cash alternative, very low risk.
ETFs.
ETFs.
Very, very convenient. As before Jeff gets started, we'll always say an ETF is like having a bag full of these different stocks that are all circled around the same investment. For example, gold stocks or something like that. Listen to Jeff carefully on this, because ETFs are very, very good.
Yeah, they've become very popular. You know, if you look at the history of investing, people initially started buying stocks. They get the stock certificates and all that stuff, but then they wanted to diversify, and the mutual fund solved that problem. You know, like Mike said, one share, I could buy one share and I might own 500 stocks, right? Well, what people didn't like about that is they wanted to be able to trade quicker. And that's where the ETF came out. The ETF came out, which stands for Exchange Traded Fund. Like Mike said, that's like a basket of stocks. They got ETFs for everything now. They have like gold, which is GLD, or oil, USO. They've got inverse ETFs that go down. If the market goes down, you go up.
They have everything.
They got ETFs for everything. So what's the benefit of an ETF? Low price, diversification, low fees, and quick execution. You can get in and out of an ETF just like a stock. So it's like a stock mutual fund, essentially. And they've become very, very popular. You know, people like the ability to get out when they want. They like the low fee.
Mutual funds use them a lot.
Yeah, they use them. Yeah. So, and they can be tax efficient. So you got the mutual fund, you got the ETF, and you go in there and buy those, right? And if you want to diversify, like Mike talked about, that's where your return comes from. Well, what happens if I like mutual funds or I like ETFs, but I don't know what I'm doing for the diversification part here? Well, this is where you hire use a managed account, right? And for a managed account, they could use all stock inside that investment, all mutual funds, all ETFs, or a mix of whatever they want, right? So why would I want to use a managed account? Well, it's one set fee. It covers all transactions. So whether they buy and sell 10 stocks, 20 stocks, or mutual funds or ETFs, it's one set fee that is a percentage of the assets that comes out quarterly, right? So this takes away.
They buy and sell. That's the important thing there.
Yeah, because you always used to wonder, you know, when your advisor would call you and say, "Hey, we're gonna move you out of this and move you into this." Is that to make their house payment, or is that in my best interest? Well, with managed accounts or fee-based accounts, that takes that off the table. It doesn't matter if that's in the best interest rule for the client when they buy and sell and reallocate, or they might like a different fund or a different ETF or a different stock in that portfolio. They're purely doing it for the betterment of the client. Now,
because they get paid a percentage if the money, if your account goes up, their income goes up. If it goes down, their income goes down. So managed accounts are great for that reason.
It's an incentive-based compensation structure, which is always good. So you lose money, they lose money. You go up, they go up. You know, Mike and I are biased towards those types of accounts. Those are what we use. It gives us the ability to switch if we don't like what's going on. And you've got institutional big money managers who will manage pools of money for clients, or some advisors do it in-house. We like to outsource it for the fact that if we've got somebody doing it internally and they're underperforming, it's kind of hard to go and fire that person or put them on watch. If our institutional managers don't do what they're supposed to be doing, we can switch it out, move it to the same fee structure, and just swap another manager in there. So
yeah, no cost to go in, no cost to go out. Yep. You just pay a fee while you're in there.
Yep. And they say minimum account size of 100,000. That's not true anymore. Most institutions, you can start off at $5,000-$10,000. But the fee-based account or the individually managed account is where the industry is now. That's what everything is moved to. You can even buy, like Vanguard has fee-based accounts now, because what you see, the problem is when you're trying to build if you want to use low cost passive managers, you might only choose one or two indexes because you don't know all about all the other indexes. So like if you use an institutionally managed active passive strategy, they're actively choosing the indexes to keep the fee low, but they're diversifying your portfolio properly because they're using different indexes. That's usually where people get hung up. Starts off, oh, I want to do this myself. I'm going to buy a couple indexes. They'll outpace everything. Well, that's not usually the case if you only buy 2 or 3 different indexes. You bring on an active manager to choose those indexes for you for a small percentage, and that keeps you out of trouble.
Well worth it.
Well worth it. All right, Mike, you want to give your annuity disclaimer?
Yeah. Annuities, okay? Annuities are good and annuities are bad, okay? Annuities, they're going to cost you a little bit more, because in an annuity, it's an investment, let's say sort of like a mutual fund, where you can buy guarantees on it. You can buy a guarantee that it won't go down X percent. You can buy a guarantee that if the market goes up, you can take a piece of that, and yet you'll have protection on the downside. Annuities are also grow tax deferred. And to this audience, another very, very important thing about annuities is that they're asset protected and grow tax deferred. But you have to be careful because there are good things about them, but there's bad things about them. Watch the cost in those things. Go ahead, Jeff.
Absolutely. You know, the first decision you have to make is, well, am I going to use IRA money or non-IRA money? The only time people would put IRA money in an annuity is if they have one of those living benefits that Mike talked about,
Right.
maybe a guaranteed principal, or there's some form of protection or some form of guaranteed income growth that people use. That's the only time you use an IRA money in the annuity, if it had some enhancement that you can only get there. But you got to watch out, right? If it's non-qualified money, that adds another set of features, essentially. So I've got taxable money. I put it into this annuity contract. It now becomes creditor protected. It now avoids probate through beneficiary designation, and it now grows tax deferred. So that was a big difference there, right?
It goes around probate, avoids probate.
So the first step is, okay, well, maybe I want the annuity for asset protection, let's say. What's the difference? People, when they buy annuities, a lot of people intrinsically think that, oh, that's just a form of guaranteed income. No, that's an immediate annuity.
Yeah.
Right? That's when you annuitize an annuity. The most popular forms of annuities are what's called deferred annuities, where you put the money in, it's either invested in the market or it's fixed and it grows tax deferred. So you got your first choice is, well, am I going to use a fixed annuity or a variable annuity, assuming it's deferred, right? Fixed is just like a CD. You give the insurance company your money for a set amount of years, 3 years, 5 years, 1 year. And they give you a fixed rate. And at the end of that, you're past the surrender period and you can reinvest it and do something else. Variable annuities go into the market. It's that simple. And it will fluctuate with what you assume the investment risk in a variable annuity. You have to choose in collaboration with your advisor, what are the best fund lineup inside here to hit my objectives, right?
You have to be careful and work with a professional when you're using annuities. They're very good. You know, we talk all over the country on asset protection, and because most of our clients are physicians. So, but you just have to be careful with annuities. They're good, but be careful.
I mean, really, the only reason you use a deferred annuity is if you're looking for some form of a guarantee that you can't get in a regular portfolio. They offer things like downside protection over a period of time, a guaranteed interest, like an income rate that you can get to create like a pension for yourself. Those are really the only times that you use them. You got to watch out for fees, but there are a lot of low fee structures out there now because these investment institutions aren't dumb. There's been a huge fee compression in the industry on managed accounts and on annuities. If I could just for a moment, I'd like to talk about fees too, because when we talked about managed accounts, people always ask us, well, what's a normal fee? You don't want to be paying more than 1.5% in a managed portfolio. Ideally, 1.2, 1.3.
Yeah, lay in there about, yeah.
And that covers everything. That covers the advisor, that covers the money manager, and that covers all transactions. A lot of them won't disclose the hidden underlying fund expenses. So they might be saying, well, billing you 1.5, but the fund expenses are 4, and they don't show you that. So now you're upwards of approaching 2. So hopefully now that you've taken this class, you understand what the questions to ask. And those questions are, what are the fund expenses? You're showing me my fee of 1.5, but are there additional fees on the funds or the ETFs that you're not really showing me? That's full transparency in those accounts. Now, on the annuity space.
Yeah, we don't mean to be not being nice when we say that. These are just the facts that he's saying. They're just the facts.
This class is designed to empower you with knowledge. So we want to make sure that no matter who you're talking to, you understand what you're actually paying. Okay. And that's a big part of this whole process. In the annuity space, they've got 0 fee annuities. They've got fees are upward of 4%. You got to watch out. Mike alluded to that earlier. You got to do your due diligence on the fee side of these things. And there's good and bad and of everything. So sorry, we just took an aside here, but let's get back to annuities. This fixed variable, that's the first choice, right? And that's deferred. That means I'm not taking income off this investment right now.
Yeah.
That's deferred. Now, there's also immediate annuities, or if I annuitize my deferred annuity. And what that means is that I'm now turning on guaranteed income that I can't outlive. Same thing as a pension.
I was
If you
just
have a
going to say
pension-
that, just like a pension.
Yeah, if you have a pension, it's the same thing. All your company is doing is annuitizing what's called the cumulative benefit, and they're giving you a form of guaranteed income. And this is where you take your period certain, which is set for a set amount of years, your life option, which is just based on your life, or a survivor option, which would be joint and 100% survivor, joint and 50% survivor. And that means that you die, the living beneficiary will get half or get the whole amount. That's how that works. And this is a layout of how that works. So when you annuitize an annuity or you do an immediate annuity, that means you lose access to the money, but it's now converted into an income stream that's structured based on your choice when you annuitize or do the annuity.
And as we said last week, you have to be very, very careful when you make your withdrawal choices from an annuity, just the way that you are with your retirement plan in your practice or at work or at the hospital. Okay, just be very careful of the withdrawal choices you make, because once you make them, you can't change them.
Absolutely. So getting back to just risk in the market, markets go up and down, right? So what are some ways that we can avoid losing money? So as a form of an investment strategy, dollar cost averaging is probably one of the most common, and you're doing it already and you don't know it.
And the easiest, by the way.
And the easiest. You're doing it in your 401k plan. Every paycheck, money goes in. If the market's down, you buy more shares. When it's down, if it's up, you buy less shares. But you're averaging in over the year by buying shares for systematic savings, which is a way that you get money in those accounts.
So what we're addressing now is what you're doing in your retirement plans and probably in your investment portfolios. That dollar cost averaging, as he just said, it goes up and down, but it's not, the price of the share is not important when you get your statement. It's how many shares you have, because historically past performance will guarantee future return, but historically the price, the shares do go up, and it's the number of shares that's important. And if I can hit an aside here, Jeff, one of the things, if you have children or young adults as children, it's great to teach them to start to invest by dollar cost averaging, have them every month on auto draft. I would do this. Have them put X amount of dollars into some type of mutual fund. That's what I do if they're starting out. And just let the dollar go in automatically so they don't have to think about it. Because as Jeff just described in detail, the market goes down, who cares? You're getting more shares. But that's a great way to start your children on investments, and it's a great way to start yourself in adding to your investments.
Another diversification strategy is staggering fixed income maturities, like a CD or a bond ladder. Particularly in this environment, you wouldn't want to go out and buy a 10-year bond right now because interest rates are going to go up. But you might do, and even the same thing is for CDs. I might do a 6-month, a 12-month, and an 18-month. That means I've got something coming due every 6 months. And as interest rates go up, I'm locking in new rates. So it's called a ladder strategy. And you can do that with fixed income, with bonds or CDs. Diversification.
The key,
asset allocation.
Investments, diversification.
Yeah. Mike talked about this with the Nobel the prize winners, and that's it. You need to develop a good asset allocation based on your risk tolerance in your time horizon. You choose a good institutional managers, you stick to that, and you only change those allocations, the percentages in each category, not based on emotion, but based on life changes. Like now, maybe I retired and I need income versus growth. That's a big life change. That's the biggest dynamic shift that we see. And that's a big asset allocation change, right? I now want passive income. I want yield. I want dividends. I want bond interest.
Yeah.
So,
Jeff, if I can bring up a point, the past year in the market has been extremely unusual with the growth. Jeff is talking to us right now about asset allocation, making sure you keep your risk tolerance, your growth stocks, your bonds, your fixed income in line. What has happened over the past year is that the market has gone up so much. A lot of people, their asset allocation is out of whack. If someone wanted to be 50-50 or 60-40, 60% equities, 40% fixed, something like that, now they're 70% or 75% in equities because equities went up. So it is very important now to listen to what Jeff's saying and look at your asset allocation, because your equity positions percentage-wise as well as dollar-wise have increased tremendously. This is really an odd year. So go and make sure you check your asset allocation, okay? And make sure it's still what you want.
that is something that we offer. We use Morningstar Advisor Workstation, which is like a 100-page report on everything from stock intersection to correlation analysis to overall macro and micro diversification. So we take statements, we run those numbers so we can tell you exactly what you own, and making sure that that matches what your actual amount of risk you're willing to take. And we can tell you this, right now people are out of whack because particularly tech had a huge run up because of COVID. And now you're starting to see money pouring back into large cap value. So those changes are all happening and people's portfolios aren't in line. You might be taking a lot more risk than you should be.
Yeah, so, and Morningstar is very objective. They're very astute. You know, ask your advisor to do that for you. You know, it's very third party. It gives you a blunt look at where you are.
Yeah, we've had a lot of physicians from these classes come and ask us to help them with that. We just plug in all the numbers and spit it out and say, here's where you actually are, because it's hard to find that. It's easy to see on one account, but when you've got 5 or 6 different accounts, it aggregates them all together in one snapshot. That's something, if you're working in an advisory capacity, that should be happening for you.
It's easy to understand. That's what's good about it for you. It's easy to understand. Oh, can I just say something? Emerging markets. Let's look at this chart that Jeff put up there. I love this one. This is for someone that says, oh, don't worry, I know what's going on in the market here. I know exactly what's going to happen. The market is so confused, and every year it changes what it is. Jeff, would you trace emerging markets on this graph for us, please?
Well, if you look at 2010, emerging markets was up 18%. In 2011, it was down 18%. In 2012, it was up 18%. Then down 2, down 14, up 11, up 37, down 14. So when you see people trying to do it yourself and try to time the market and not stick to an asset allocation model and let the market come to you because you have something in each of all these categories, usually what happens is you buy it at the end of 2010, if the bottom falls out, then you sell it in 2011 and lose 18% and then get in that vicious cycle. So you want to design a good asset allocation, have something in each category based on your risk profile, and manage it that way. Not trying to time the market or chase what's hot. That doesn't work.
Okay, does everyone get the point? We don't know what's going to happen. You don't know what's going to happen. Asset allocation gives you the luxury of the variety that's going to protect you, and it's going to protect the money that you have accumulated over the years.
Yeah, and Mike had talked about the Nobel Prize winners in the economic science, the modern portfolio theory. That's what this talks about, taking on, getting the maximal possible return for the amount of risk that you're willing to take. And that's called modern portfolio theory. Okay, that was the investment chapter. Did we have any questions on that at all in the chat? Doesn't look like
no, not at this time.
Okay.
That's one of the shortcomings of Zoom meetings. When we have them, when we're teaching a class in person, the interaction is unbelievable. and Zoom
Yeah.
kills that. So we do apologize for that, I guess. But okay.
All right. Disability, Mike.
Okay. And I said this last week, but risk management. Like I say, how do you manage risk? You can't really manage risk. You just have to prepare for risk. One of the biggest things that I see, and more money managers, but we do total planning, is if a physician, and as I said last week, I can name people that that have just been struck in different ways and they become disabled and they can't earn any money. It's tragic. Okay. So, I'm extremely objective in things, but I think when it comes to disability, I'm a little bit unobjective because I see it so much. Make sure that you all have good disability insurance, because you should be insured that if you can't do every duty of your specialty, not just your occupation, your specialty, that you're going to be paid. You need to have that. It's a tragedy for anyone, but especially for physicians. And unfortunately, we see that a lot. So make sure that you've got disability insurance. Two basic kinds, if I can continue, Jeff. Two basic kinds of disability insurance. One's called an individual non-cancelable contract and it gives you an own-oc or your specialty occupation coverage, which means once the policy is issued, they can never change it. They can never raise the rates. But the important thing is they insure you in your specialty. The big thing, surgeons say, oh, I can't scrub. If I can't pick that scalpel up, they're considered totally disabled, whatever your specialty is. You've got to make sure it's an own occupation, your specialty contract. That's disability. There's also group disability. So the best way to do it, now remember, I'm a little paranoid about this, so take me with a grain of salt. You buy the individual non-can as much as they'll give you, and that'll be a percentage of your income the insurance companies will give you. And then you probably have group disability at work, at the practice, at the hospital where you work. You're going to have group disability. Then put the group in on top. Group will underwrite you. It's easier to get, but it can be changed. It can be canceled. But make sure that your advisors have you with a cover for disability insurance. Yeah, Jeff.
You get the waiting period. That's just the amount of time until the policy actually pays, the monthly benefit, and then for how long it pays. Most good policies will pay to age 65. Yeah,
the cost will be the longer you delay the payment. If you get it first day, it's going to be more expensive, obviously. If you push it out 30 days, 60 or 90 days, the premium gets lower. And they usually, on the good contracts, they write it to 65, but you can renew it to age 70, 70 and a half in the good companies. Okay.
All right. So what's probably more relative I know this is kind of an older target audience here today. I mean, you'll probably already have bought your disability, but long-term care plays a huge role in the overall planning, and that covers eating, bathing, dressing, toileting, and transporting. And when you're inability to do that and you need some help, how is that taken care of?
Yeah, there's 6 daily living activities. If you can't do 2 of them, you would go on claim, or mental. You would go on claim. And as some people say, if you want to see your assets get depleted real quick, need long-term care. And there's ways that you can buy that where it's sort of, they have the last 2 or 3 years. Before, you would just buy long-term care, almost like disability insurance. You pay a premium, you never get anything back of your money, but you're covered. With long-term care, they have a hybrid policies now. I call it the rich get richer and the poor get poorer. Because the new hybrid policies, what they're saying is, we will give you coverage, but you have a lump sum that you have to put in. Some will spread it out in a few years, but basically you have to put in a lump sum of money. And the hybrid gives you the long-term care coverage, but it also gives you a cash value with it and an instant death benefit. They're very good, but you have to have the money to do it, but they're excellent. Good, Jeff, sorry.
Yeah, that helps. The biggest The biggest issue with buying traditional whole life, long-term care, was that what happens if I don't use it? Like a homeowner's policy, you're paying these huge premiums, but then you don't end up getting to use it. With the hybrid policy Mike talked about, you have a walkaway feature as well, that usually after about 5 or 6 years, you break even, and then you can get your money back. So that addresses a big issue with the issue with people had was like, I don't want to pay this and not use it. Well, now if you die, you get a death benefit for your estate. If you need the long-term care, you got a bucket of long-term care money, and then you also can make some money on it while it accumulates. So it's multiple uses out of $1, which is nice.
Right, and it's asset protected and grows tax deferred. Asset protected.
All right. Life insurance.
Life insurance.
Term versus cash value. Michael?
Okay. If you have a need for life insurance in your life, no pun intended, there's basically two types. One is called temporary term insurance. Okay. Temporary term gives you buy a death benefit. You don't build any cash, and it lasts for a certain period of time. For example, the most used thing for that is if you have we have clients that are in real estate, they may buy a strip center that they're going to keep for 10 years and then flip it. They'll buy term coverage to cover a loan or death benefit that ends. Term ends. You can get a 1-year term that goes up a little bit every year. And they say if a coronary doesn't kill you, by the time you see what your term life premiums are, that'll kill you. So, but its term comes out cheap. You can get a 10-year term that lasts for 10 years. It'll stay level. And then it ends, or a 20-year term. And a lot of people badmouth term insurance a lot. I mean, yes, you don't make any money on it. Yes, the chances of term insurance being turned in for death benefit are less than 1%. It is a pure profit item for insurance companies. CPAs don't like it. But you know what? If you've got some young couple that doesn't have that much money and they have a couple of kids or something, they need it. Okay, so that's term, temporary term. The other type is something called permanent. You hear it called whole life, life paid up at 65. They're just life insurance contracts that provide a death benefit, but they also build cash. And the cash grows, once again, tax deferred, and it's all asset protected. You usually pay for life insurance contracts with after-tax dollars. So when you take those dollars out, they come out tax-free. You have your qualified plans. Doctors accumulate their wealth in two main places. Number one are their qualified plans, and then they get taxed when they come out, most of them. Remember, we love Ross. And then the other is they'll use their cash value in life insurances as a non-qualified type of plan where it comes out tax deferred. So, if you have a need for a death benefit, the best way is obviously to do the cash value type, but if it's only temporary, you don't need to do that. If you don't have the money, then you don't need to do that. But basically, one's permanent, one's term, one grows, one doesn't, one has no cash value, one's asset protection.
So whole life insurance, there's different types of cash value. Whole life insurance has guarantees in the contract. They pay dividends, which is a nice feature. As long as you pay the premium, the policy stays in force. Universal life policy.
Once your cash value gets high enough, you don't even have to pay premiums.
Yeah, that's true too. And the dividends pay it. Right. Universal life is interest rate sensitive. So if you would purchase a universal life policy, let's say in the 80s, your interest rate was a heck of a lot higher than it is now. So what happens is your cost of insurance goes up as you get older. And if your assumed interest rate that you used when you bought that policy has dropped below what your target was, you run into some problems. And that problem is I paid all this money in and it may not last until the age of when I need it. And it can lapse, or you might have to put a lot of money into it. Yeah, so universal life policies need to be monitored in the form of what's called an in-force ledger. You can order that from the insurance company. They send it to you. You can look at if it pays at current rates or the contractual floor of the policy, how long has this policy lasted, the current amount of capital that I'm putting into this contract on an annual basis, and make sure that it looks healthy.
In other words, you have to be very careful with universal life. If you're going to buy it, there is a type of universal called guaranteed universal life. It's usually guaranteed to 100. that means that that type of policy is going to be guaranteed that it'll stay in force to age 100. You're obviously going to have to put in more dollars than you would on a normal universal life. Okay.
Variable life is even worse than universal life in the sense that you're now invested in the stock market. And a lot of people, unfortunately, when they bought these, they used an assumed rate of return that they didn't actually get net of fees. And if that happened, the same situation, your cost of insurance goes up. The market didn't meet its expectations. It's running out of cash, and that cash will only last X amount of years, even when you're paying the annual premium. That's a problem. So you need to monitor that and use a likely assumed rate of return or even zero to make sure that that policy is going to stay in force. Because the last thing you want is, again, your 80s or 90s, and it was designed for a legacy transfer. Now all of a sudden you got to keep dumping more and more money in it to keep it alive. That's a problem.
Put your risk in the regular stock market. You know, buy some stocks, bonds, mutual funds there. Don't do that with your life insurance, because the life insurance has a bigger, it's a bigger answer to certain problems in life. So you don't want to mess around with that.
All right, let me jump to this. Okay, so we just wrapped up the presentation. We covered Social Security. Hopefully you guys learned a lot about that tonight. Investments, and then long-term care, disability, and life insurance. Now, all those things we talked about, your overall financial plan plays a huge role in tying that all together. From the retirement plan growth to what I need to hit for my retirement numbers. Am I okay if I died or became disabled? So, Mike, let's go through this. This is what we do, and this is if you decided that you wanted to get this done. This is where we waived the fee due to our relationship with the HCMA. So there's a very thorough analysis of your current situation, and this is free to do, which doesn't come around too often. So let's take a look.
Yeah, but remember, as we start to look at this also, yes, that is something that the HCMA has us doing for their physicians, but it doesn't have to be with us. I mean, it'd be great if it was, but I mean, just make sure you have a CFP do a plan for you. Make sure that it's done, and make sure you review it every year. This is what we do. We're probably a little bit more detailed than most people. I know I'm a little OCD on a lot of things, but this is the type of report you need to do, and you need to review it every year with your advisor as though she or he's never met you before. So this is the type of plan that we do. Okay.
Mike, you did bring up a good point. Whether it's with us or not, we just want to show you what you should be doing.
Right.
In your life as you prepare for retirement. This is the type of analysis that needs to be done to get there. Did you want me you want to go over this part, Mike, or do you want me to go over to the net worth? Or
well, I'll make comments on this first in the beginning here. You'll see. Do you ever hand a report or a brief or a chart to someone and say, "Hey, do me a favor, take a look at this and maybe write a note on it"? Well, these days you got to be very careful with that. And you ever get it back and someone's written all over this report that you did with all their comments? That's sort of the way we do it. We write comments through everything. And when we give an opinion, just because we have a bunch of letters behind our names, it doesn't mean we know anything. When we write our comments, this is how we're thinking. If someone said, "Mike, Jeff, what do you have to do to become financially independent?" You can only name 5 things. Impossible. You have to put it in order. Impossible. But if they put a gun to our heads and said that, how would we answer? We would answer this. Most important thing, the top 5 things. Number 1, you've got to have an emergency reserve. If you don't have an emergency cash reserve, you're going to get hurt. Second, no matter how smart we are or how dumb we are, if we have a client that has an accumulation goal that is subjective, we've learned we have to deal with that. Number 3, financial independence. That's what we are about. That's what a good planner should be about. Very, very long term. Disability, that's number 4. I'm not discounting the need for life insurance. I think that's extremely important. I just see the tragedies so often with disability. So that's how we think. And we begin our reports like that. Okay. In a regular report like this, we take all your personal data. Okay. And we put your advisors in, because believe me, this PDF, if something goes wrong, this PDF, or actually we do them in nice books. They're pretty cool also. This is what they grab. So we put all their financial advisors in there also, because when something bad happens, they grab this PDF or they grab this book. So that's why that's there. Go ahead. The main thing that we're doing, well, that's just an asset allocation. Let's pass that by. The main things that we do are the two basic CPA, CFP documents, and that is a statement of net worth and a cash flow statement. Right here, what we have, and this, by the way, these are actual clients. This is a statement of net worth. We list all their assets, liability, and then we summarize it in English what they are. And this is where this client was. And all right, so that's the statement of net worth. And then we show you what their money, investable money is. And then we do the cash flow statement.
This is emergency reserve, which we talked about.
I know, it's out of order.
Yeah.
Okay.
No, it's right there. It's emergency reserve. I'm making sure that there's not a lag. Are you seeing the same page I am?
I'm looking at emergency reserves, but usually I do cash flow next.
Okay,
anyway.
Yeah, it's coming up. There it is. There it is. Okay, good. There we go.
But the cash flow is the other bookend for financial planning, a cash flow page. That's how much money comes in, how much money goes out, and what's left over. That is extremely important also. Those two documents, statement of net worth and cash flow statement.
Yeah, we covered that in session 1, and we also talked about.
Right, but this is in the report. I just wanted to go over it.
Absolutely, yeah. But when we talked about it, then we also talked about, we do have an Excel spreadsheet we can help you with to send you over if that's something you want to work on. The numbers that are coming in now are important, but also when you're trying to calculate what your retirement number is going to be, that helps with the cash flow as well. All right, income tax. There you go.
Yeah, we do tax analysis. We use software for that. We have CPAs also. We work with a lot of CPAs that looks at needs at disability. Actually, this person was okay there. And we go through these type topics, the basic things.
Long-term care.
Long-term care. Then we get into education. This client had children, so there was a need there. I mean, we do Section 529s. We're a big believer in estate plans also. So we do education planning, retirement. The key is we work on the retirement numbers. We put the scenarios out. We use conservative rates of return in these. In this case, it looks like this person ran out of money at 77. So we had to do some changes on that. But I mean,
if I could just talk about this page, because this kind of brings everything together from the first chapter or the second chapter last week, when we talked about inflation and how to take that into consideration. So when you looked at their need, 199,000, that's going up by 3% a year to maintain their purchasing power. The next column would be pensions, social securities. We put them in, they both took it at an early age at 62, but we ran one at 70 as well. And then we made at a conservative rate, we want to make sure that they last until age 100, if you remember from the last class. So in this case, they needed to save or earn more money. And then it calculates, well, what rate of return would I need to achieve in order to hit my target, or how much money would I need to put away additionally on a monthly basis to get there? So that page for the retirement is very critical.
Yeah, that save more, earn more page that we do when we're doing retirement planning, that's critical. That is, people say, Jeff, Mike, well, what do I have to do if I'm behind on my goals? What do I have to do? And we say, I don't know what rate of return you're going to get. That'll determine it, your rate of return. So we run all the different rate of returns. And as you can see, this person really didn't have a problem. Past performance, no guarantee of future return, but all they had to do is make their return come up to 6.59%, and they would have been fine. So it's, that's the type of work we do. We're very detailed on that. Go ahead, Jeff.
And then we just come up with, not going to get into that part. What if you die? What happens there? They were okay.
They were okay. They had enough insurances. They were fine.
Yeah. The Will's Point checklist. That's an important one.
Yes. This is a list of questions. It started out as 10, but I passed it around to different attorneys and people, and now I'm up to 21 questions. That's pretty much what an attorney is going to ask you when she or he does your wills and trust. Or this is a way for you to review it. You should be reviewing your wills also, and it's a great way for you to do it. This last thing, it's a little depressing, but you know, we are the ones who get the first call, and this is a guideline for a letter of final instruction. This does not go in your safe deposit box. This has got to be somewhere where the person, if something happens to you, who's ever going to bury you, I know that sounds terrible to talk like that, but they need it, whether it's your spouse, children, friends, they need a copy of this. And this is very basic, because this is what you get involved in, is I want to be buried. I don't want to be buried. I want to be cremated. I don't want to be cremated. I don't want to be left on life support. I want a religious service. I don't want a religious service. I want a get together afterwards. You know, I don't want that. Those kind of questions are things that your survivors have to answer immediately as they're going through terrible trauma. So having a letter of final instruction, I think, is just excellent. And from experience, it helps everyone. And then we do another review at the end. You know, they were okay in the emergency reserve. They needed the education fund, but they were pretty much okay. And then we do a summary in English. Here's the recommendations in understandable language. And, you know, we start there and we say, okay, there's the things you need to do. And that's,
yeah, go ahead, sorry.
And that's it. And we start from there, and we sit down and review this with every client as though we've never met them. Every year we do a review and we start as though we've never met them before. And when we do the reviews, there's no fee once you become a client.
The other component to this, which has become real popular now, which is the full analysis of the current investments, where we take the statements and we run a full-blown analysis to make sure that you're invested correctly based on your risk profile, particularly in these markets that have gone a little crazy. Make sure you're only taking an amount of risk that you feel as though is adequate for your current situation. And then we match that to your plan and make sure that all that's cleaned up. So whether you use us or somebody else, this is the type of work that is crucial at this stage in the game as you're approaching retirement.
And remember, it's never too late to make sure you have things in order.
Absolutely.
So that's pretty much it. Do we have any questions?
Let's give everybody a couple seconds here to type some in, but right now there are not.
Okay.
Must have did a really good job, Mike.
Mike and Jeff, how anybody interested in this financial portfolio thing that you mentioned, how will they get a hold of you?
Well, Jeff, don't we have a
slide?
Well, inside the folder that we sent to everybody, also Elka will be sending tomorrow morning an evaluation to get feedback.
The evaluation form.
Yeah, it'll be on there. Okay.
Yeah,
Okay.
if you check that you want to meet with us or you've got questions, we'll reach out to you same day and schedule a Zoom call or have you come by the office. We're right at Kennedy and West Shore, so we're right in the financial district downtown Tampa. So,
And remember, one of the last things that Jeff and I will say to you this evening is, when is the last time you've read your wills and trust? Please make sure they're current.
so if we don't get any other questions, I think we ended a little early tonight, which was good. So,
Well, you know that
Okay.
with no questions, that means we were either excellent or everybody's asleep. You know, so
Well, we had 18 hang on to the very end. They may be asleep though. Okay.
all right.
Mike and Jeff, thanks again for your time tonight, and hope everyone enjoyed as much as I did. Again, you can still contact them for further questions on your own, and then make sure you fill out the survey that comes tomorrow, and
Yeah.
their contact information will be on there.
yeah, it's also in the folder we provided with the books. So
Yeah.
they should have it. Everyone should have it. Yep, that one. Yep.
Okay.
And
So-
we have, it is Physicians Wealth Planning is a Jensen Anderson company. That's our physicians group. So don't get confused. Jensen Anderson started as just full service financial planning. And then we started continuously working with physicians. So it's Physicians Wealth Planning, a Jensen Anderson company, just so people don't get confused.
Yeah, it's
Okay.
the same thing. It's just Physicians Wealth Management, just one of our companies.
Mhm.
Thank you, everyone.
Okay.
Thank you.
We're
Good night.
getting some thank yous from the crowd. So, but no further questions.
Okay.
So thank you for joining us, and everyone have a good evening.